is an update and technical analysis on Antero Midstream Corporation, a company of the energy sector, oil and gas midstream, here off the daily interval. And in the period leading up to April 7th, there has been a significant downturn in crude oil shipments from Russia's export terminals, with a drastic decline of 1.24 million barrels per day, resulting in an 8-week low of 2.89 million barrels per day, as Russia had surpassed Saudi Arabia as China's leading crude oil supplier in January and in February, and continued to maintain its position as India's top oil supplier for the 5th consecutive month in February, surpassing all these traditional suppliers from the Middle East and Iraq, Saudi Arabia. This huge drop in crude oil exports, which is the sharpest decline since the disruptions caused by storms at the ports in December, raises all kinds of concerns that Russia's production cuts may be impacting its ability to fulfill the crude oil shipments. It also raises the possibility of a looming economic recession, with signs of consumer demand completely being shut down, slowing down. This development calls for careful consideration of the factors affecting Russia's crude oil shipments and its potential implications on the global energy market. As the recession heats up, a lot of traders will go and bail out and have a demand crush, in which will be highly affected in Antero Midstream Corporation is the spot price of oil, with our both West Texas Intermediate crude oil futures are at a crucial pivotal point, inflection point, and here we are off this primary downtrend line, right off the 2023 January reactionary highs. Multiple reactionary highs to help validate that, and this really sets up for an objective short trade entry, coinciding with the 1070 price resistance off this primary downtrend line. We are seeking to break out of that 50 and 50 exponential moving average, but this is something you could begin scaling in. Call it an aggressive short trade setup, where we will have some of these key in targets for some fibs retracement levels right amongst this 618 fibs retracement. Call it 1023 price support, and the call it 990 382 50% fibs retracement there for some of your leading targets, coming down to this first target for a 3.4% drop, down to 50% fibs retracement for a 6.4% drop, down to this back to this primary uptrend line here off the July reactionary lows of 2022 for a 7.5% drop, and ultimately, if this is taken out, coinciding with the 960 price resistance, call it a potential sell signal if taken out, and a move down to that 920 price support there. If things get real bad, that's an 8.8% drop down to 920 for a 12.5% crash, and then if things really to take off from the next gear, down for a 19.2% crash at 854 price support there. So key inflection point, even amongst all key momentum indicators, testing their zero lines up about, and dual resistance, call it, with the primary downtrend line there for potential short trade setup down to these key inflection points. And then everything, all eyes, bull traders need to see this heavily defended at all costs. As far as the bullish case scenario, bull traders, long traders, long-time investors, they want to see a solid breakout right above that 1070 price resistance, coinciding with that downtrend line there. They want to see that taken out on a quick move. 100 fibs retracement for a 4.7% in gains, and ultimately challenging new all-time highs. But it's exactly what I see here is a complete trading range. We have multiple reactionary highs amongst this, and that's exactly what we're doing. Just chopping around in this huge consolidation period that has been continuous. It's going back for the last 2 years of pure consolidation. On high, covering low, buy low, sell high, cover low. You get the picture. But that's all we're doing is chopping around in this huge consolidation phase, and here we are, right amongst this key inflection point, where the risk-reward ratio lies heavily to the downside. I'm going to zoom in closely here and really scrutinize and focus on the specific occurrence of two reactionary equal highs, which have exhibited a pronounced negative and bearish exaggerated divergences across all three momentum indicators here. Furthermore, these divergences have persisted and only extended, forming a foundation for even more substantial and conspicuous patterns here. Just another inflection point where this technically induced divergence created that 16% crash. And again, we're just at a key inflection point. As far as any candlestick patterns, we have a beautiful bearish engulfing. Wasn't a solid candle close, but that is without a doubt a textbook bearish engulfing looking pattern there. And what I really want to do out here is I'll zoom out really way out here on the monthly interval, where we have a bearish dark cloud cover continuation pattern, and definitely not the most well defined, but definitely one to be heavily respected, only increasing the odds for more downside to come, as the larger extended long-term intervals always usually overpower the near term.